Western Digital, ticker symbol WDC, has quietly transformed from a traditional hard drive company into one of the more interesting beneficiaries of the artificial intelligence infrastructure boom. But after an enormous rally and a major pullback from its June high, investors are asking an important question. Is Western Digital still undervalued, or has the AI storage opportunity already been priced into the stock? In this video, we're going beyond the stock chart. We'll examine Western Digital's business, financial performance, AI opportunity, competitive advantages, risks, valuation, and finally build a realistic bull base and bear case price target. Let's start with the business. Western Digital is fundamentally a data storage company, with its core opportunity centered on hard disk drives, especially high-capacity drives used in data centers. Think about what happens when AI models generate enormous amounts of information. Training data, inference data, video, images, backups, analytics, and enterprise information all need to be stored somewhere. Not every piece of that data needs an expensive, ultra-fast SSD. For massive amounts of lower-cost bulk storage, high-capacity HDDs remain extremely important. That is where Western Digital sits in the AI infrastructure ecosystem. Here's the part of the story that many investors overlook. AI isn't only about GPUs. NVIDIA sells the computing engines, networking companies move the data, and memory companies provide high-speed memory. But eventually, all that data has to be stored. AI workloads are creating an enormous amount of data, and hyperscale data centers need storage capacity that is economical on a per terabyte basis. This creates a second-order AI opportunity for companies like Western Digital. The company doesn't need to sell an AI accelerator to benefit from AI spending. It needs data center customers to keep building infrastructure, and that's exactly what we're seeing. Some investors may ask, if SSDs are faster, why would anyone still want hard drives? The answer is economics. For enormous data sets, cost per terabyte matters tremendously. Recent industry data shows enterprise SSDs can cost dramatically more per terabyte than HDDs, while hyperscale operators still need huge amounts of capacity. In August 2026, reports indicated that 30 terabytes enterprise SSDs were priced at many times the cost of comparable HDD capacity, highlighting why HDDs remain attractive for bulk storage. Now we get to one of the most important parts of the investment thesis: supply discipline. The HDD industry is highly concentrated, with Western Digital and Seagate among the dominant players. At the same time, data center demand has been accelerating. Recent industry reports suggest nearline HDD capacity has become extremely tight, with some supply effectively committed well into 2027. When demand rises while supply remains constrained, manufacturers gain pricing power. And this isn't just an exciting story. The financial statements are beginning to prove it. Western Digital generated approximately $12.9 billion of revenue in fiscal 2026, representing roughly 36% growth from the previous year. Even more impressive, profitability expanded dramatically. Full-year non-GAAP EPS reached approximately $10.22, more than doubling year over year. This is what makes the current cycle particularly interesting. Revenue is growing, but earnings are growing even faster. The latest quarter provides an even clearer picture. In fiscal fourth quarter 2026, Western Digital generated approximately $3.75 billion in revenue, up 44% year over year. Non-GAAP gross margin reached 54.4%, while non-GAAP EPS came in at $3.56. The company also generated approximately $1.28 billion of free cash flow during the quarter. Those are not numbers you normally associate with a struggling legacy storage business. They demonstrate significant operating leverage and improving economics. For me, one of the most important metrics isn't revenue, it's gross margin. In fiscal third quarter 2026, Western Digital's non-GAAP gross margin was around 50.5%. By the fiscal fourth quarter, it had climbed to 54.4%. That expansion tells us the company isn't simply selling more drives. It is benefiting from better product mix, pricing, manufacturing efficiencies, and a stronger supply-demand environment. If margins remain elevated, earnings could grow substantially faster than revenue. This brings us to operating leverage. Imagine Western Digital increases revenue by 20%, but its operating expenses grow much more slowly. A large portion of that incremental revenue can flow directly into operating profit. That's exactly why cyclical hardware companies can experience enormous earnings swings. When the cycle is weak, margins collapse. But when pricing, utilization, and product mix improve simultaneously, profits can explode. Western Digital's recent operating performance shows that this leverage is working in shareholders' favor right now. Now let's separate accounting earnings from actual cash generation. Western Digital generated approximately $1.39 billion of operating cash flow and $1.28 billion of free cash flow in fiscal fourth quarter 2026. That's a very important signal because free cash flow gives management flexibility. The company can invest in technology, support capacity expansion, strengthen the balance sheet, or return capital to shareholders. For a capital-intensive storage company, strong free cash flow is particularly important. A fundamental investor also needs to look beyond the income statement. The question isn't simply, how much money is WDC making? It's, how financially resilient is the company if the cycle turns? Western Digital's improving cash generation profile gives it substantially more flexibility than during weaker storage cycles. However, investors should continue monitoring debt, capital expenditures, working capital, and share count because the HDD industry requires significant investment to maintain technological leadership and production capacity. Western Digital's competitive advantage isn't a traditional software-style moat. Its moat comes from engineering expertise, manufacturing scale, customer relationships, technology, and enormous accumulated experience in high-capacity storage. Increasing HDD capacity isn't easy. Companies need to improve areal density, reliability, energy efficiency, manufacturing processes, and data center economics. Western Digital's development of higher capacity technologies, including its UltraSMR platform, is important because increasing capacity per drive can improve economics for both customers and the manufacturer. The biggest direct competitor is Seagate Technology, while SSD and NAND storage companies represent an important alternative technology. But I don't think the investment thesis requires HDDs to defeat SSDs. That's the wrong way to frame the market. The better question is, which storage technology is most economical for each workload? SSDs win when speed and latency are critical. HDDs can win when customers need enormous capacity at a lower cost. If total data continues growing exponentially, there can be room for both technologies. The biggest catalyst for WDC is continued hyperscaler spending. Companies building AI infrastructure need enormous amounts of storage around their computing clusters. As AI moves from training toward inference, agents, robotics, autonomous systems, enterprise AI, and increasingly data-heavy applications, the amount of information being generated and retained could continue increasing. Recent analyst commentary continues to identify Western Digital and Seagate as beneficiaries of AI-related data center infrastructure spending. Now let's talk about the elephant in the room, valuation. A great company can still be a bad investment if you pay too much. Western Digital stock has experienced an extraordinary run in 2026, followed by a significant correction. Recent reporting showed the shares had fallen sharply from their June peak, even while the underlying business remained very strong. The market is essentially saying, we believe the business is fantastic, but how much of that growth is already reflected in the stock price? This is fascinating. Western Digital reported strong numbers, yet the stock reacted negatively. Why? Because stock prices don't respond simply to whether earnings are good or bad. They respond to the difference between expectations and reality. If investors expect exceptional growth and the company delivers merely excellent growth, the stock can fall. Recent reports specifically highlighted profit-taking, elevated valuation expectations, and analyst downgrades as factors behind the weakness. Let's build the bullish scenario. Suppose AI infrastructure spending remains strong, hyperscalers continue expanding storage, HDD supply stays constrained, and Western Digital maintains strong pricing and margins. In that environment, earnings could continue growing rapidly. The company could also benefit from higher capacity drives and increasing demand for nearline storage. Under an aggressive bull case, I could see the market assigning a premium multiple to rapidly growing earnings, potentially putting WDC in the $650 to $750 plus range over the longer term. This is a scenario, not a guaranteed target. Now let's be realistic about what could go wrong. First, AI infrastructure spending could slow. Second, hyperscalers could optimize storage more aggressively. Third, SSD technology and pricing could improve enough to take share from HDDs in workloads where HDDs currently dominate. And finally, because WDC is cyclical, today's extraordinary margins may not last forever. If earnings normalize while the valuation multiple contracts, WDC could potentially fall toward the $320 to $375 area in a serious bear scenario. This is why investors should never confuse a strong business cycle with permanent earnings power. My base case sits between those extremes. If Western Digital maintains strong data center demand, but margins gradually normalize rather than staying at peak cycle levels, I would look at approximately $500 to $575 as a reasonable medium to long-term valuation zone. There is also a wide range of Wall Street expectations. One current source shows an average analyst target around $671.64, with published estimates ranging from $525 to $1,050. That huge range tells us something important. The market has very different opinions about how sustainable this storage cycle will be. So, what's my final verdict on Western Digital? Fundamentally, I think WDC is one of the more compelling AI infrastructure storage plays because the thesis is supported by actual revenue growth, expanding margins, strong earnings, and powerful free cash flow, not just an AI narrative. But after the massive 2026 rally, valuation and expectations have become the biggest risks. Personally, I would categorize WDC as buy on weakness, accumulate, rather than blindly chase the stock after a strong move. The long-term bull case is compelling, but position sizing matters because HDD is still a cyclical business. And that's the key takeaway. Western Digital doesn't need to become the next NVIDIA. It simply needs the world to keep generating more data, and for hyperscalers to keep needing enormous amounts of affordable storage. If that trend continues, WDC could have significantly more room to run. But if AI spending slows or margins normalize faster than expected, the downside can also be substantial.